What if I told you that training the next breakthrough AI chatbot requires a single factory tool that costs like more than a commercial airliner?
Yeah, it's honestly wild. We're talking hundreds of millions of dollars just for one highly specialized machine.
Right, just sitting inside a pristine, heavily guarded factory that is literally the size of a small city.
Exactly. And, usually when we talk about the AI revolution, we obsess over the waitlist stuff,
Oh,
right?
for sure. The algorithms learning, the massive data sets, the glowing code on a screen.
Yeah, we treat it like magic happening in the ether.
Yeah.
But the physical reality behind that software is arguably the most complex, expensive hardware human beings have ever attempted to build.
It's like we're obsessing over the aerodynamics of a Formula One car, but completely ignoring the companies that actually forge the engine block.
That is a perfect way to put it.
So today, we're taking a deep dive into the metallurgy of this AI boom, the hidden, highly lucrative engine known as semiconductor capital equipment.
Or semicap for short.
All right, semicap. These are the companies manufacturing the colossal machines that actually print the microchips.
And the financial stakes attached to those machines have completely detached from historical norms. I mean, we're looking at a May 2026 financial research report from Goldman Sachs today, and the scale of capital being deployed is it's staggering.
Yeah, to give you a sense of that scale right out of the gate, semicap stocks are up 68% year to date.
Which is massive.
It's insane. They're absolutely crushing the broader semiconductor index, which is up a respectable but, comparatively smaller 43%.
Right. So the question on everyone's mind is whether we're at the peak of a massive bubble or if there is actually more upside hidden in these heavy machinery companies.
Exactly. And our mission for this deep dive is to unpack exactly how financial analysts predict the future of these complex hardware giants.
We want to connect the dots for you, from those massive cloud computing budgets at companies like Amazon and Google, all the way down to the actual equipment orders on the factory floor.
And ultimately to the stock prices. We want to help you understand exactly what scenarios are priced in right now.
Because when you decode the mechanics of how that money flows from a software giant down to a heavy machinery manufacturer, the stock prices start to look less like gambling and more like, well, applied physics.
Applied physics, I like that.
Yeah, and the entire industry runs on a metric called WFE, or wafer fab equipment spending.
Okay.
This just tracks the total capital dropped on machines required to process raw silicon wafers into functional chips.
Okay, let's unpack this. How does a software giant deciding to build a massive new AI model actually translate into a heavy machinery manufacturer having a banner year?
Well, there has to be a tangible formula, right? Analysts need something to bridge that gap between a software budget and a hardware purchase order.
Yeah, they can't just guess.
Exactly. So they use a historical benchmark called the 9% WFE sensitivity rule.
The 9% rule. Got it.
Yeah. The Goldman Sachs report models out the gross capital expenditures, the CapEx, for the big hyperscalers.
These are the tech titans running the internet's infrastructure, right?
You're right. And the report projects their total budgets reaching a massive $1.16 trillion by 2028.
Trillion. With a T.
With a T. And historical data, which is actually backed up by management commentary from the semicap companies themselves, shows that for every $100 billion of incremental data center investment by those hyperscalers, roughly $8 to $10 billion in wafer fab equipment demand is generated.
Oh, okay, so analysts just apply that 9% sensitivity rate to estimate how much the total WFE pie is going to grow.
Exactly.
But, handing a tech company $100 billion on a Tuesday doesn't mean they buy $9 billion of machinery on Wednesday.
No, not at all.
The timeline can't be that immediate,
Right.
especially when you consider we were talking about machines the size of city buses that take like months to assemble.
Oh, the lag is significant. I mean, before you even order the machine, you have to acquire the land, pour thousands of tons of concrete, build the sterile clean rooms.
Which are what, thousands of times cleaner than an operating room?
Exactly. And secure a power grid capable of running these massive systems.
So how do the financial models account for that delay?
They handle this reality by assuming a 50-50 split in WFE spending between the current year and the previous year.
Okay, so if a cloud provider commits the budget today, half the equipment spending hits the models this year, and the other half hits next year.
Right. It perfectly reflects how equipment orders lag behind the actual data center construction.
Okay, I hear the logic of the modeling, but I have to push back here a little bit.
Sure.
Investors are, frankly, terrified right now of this idea of peak AI CapEx.
Spending cliff.
Yeah. There's this looming fear that eventually these hyperscalers are going to look at their sprawling server farms and decide, hey, we finally have enough compute power.
Right. The gold rush ends.
Exactly.
Mhm.
If investors are terrified of that moment, if that spending suddenly stops, doesn't the entire heavy machinery business completely collapse?
You'd think so, definitely. But the Goldman Sachs data completely rejects that premise. Yeah. Far from slowing down or preparing for a cliff, they just raise their global WFE estimates across the board.
Wait, they raised them.
Raise them. The new projections anticipate wafer fab equipment spending hitting $141 billion in 2026, $186 billion in 2027, and soaring up to $208 billion by 2028.
So the numbers are literally moving in the opposite direction of the market's fear.
Because the demand isn't just some spreadsheet projection, It's driven by severe physical capacity constraints happening right now on the factory floors.
Ah, okay. Constraints on what exactly?
Well, the industry is hitting a wall in memory production, specifically DRAM, which provides the short-term working memory for processors, and NAND, which handles long-term data storage.
Got it.
And we are also seeing severe bottlenecks in advanced foundry logic, which are the actual brains of the chips.
Okay, that makes physical sense. When you hear about companies racing to produce high bandwidth memory, or HBM, for the newest AI chips, they aren't just tweaking their old assembly lines. lines.
No, not at all. They need an entirely new fleet of highly specialized wafer fab equipment to handle those advanced designs.
Wow.
And those baseline constraints are suddenly looking incredibly modest compared to the massive curveball thrown into the models earlier this year.
Oh, you're talking about the Terafab announcement.
Yes!
Yeah, that was wild. So in March 2026, Elon Musk announced this initiative to vertically integrate semiconductor manufacturing under a single roof.
Right.
And the stated goal is to enable 1 terawatt of annual AI compute capacity. A terawatt. The sheer electrical and physical scale of that is mind-bending. I mean, a terawatt is enough power to run several small countries.
It's an unprecedented concentration of power and manufacturing ambition. And what's fascinating here is that the report notes Terafab is already in deep discussions with key equipment suppliers.
Like who?
Like Lam Research, Applied Materials, and Tokyo Electron.
So a single mega project is literally moving the needle for the entire global industry. Are giant idiosyncratic projects like Terafab basically a positive black swan event for financial modeling? I mean, predicting the WFE market now seems to require predicting the whims and sudden mega projects of tech billionaires.
Which is pretty much impossible.
Right. It feels impossible to model accurately.
It does introduce a level of extreme concentration risk that goes way beyond traditional macroeconomics.
Yeah.
You aren't modeling the global economy anymore. You're attempting to model the ambition of an individual. But from the perspective of the semi-cap companies, a purchase order is a purchase order.
Money is money.
Right. Whether it comes from 50 different tech firms or one massive Terafab facility, the tools still need to be built, delivered, and paid for.
So how does the report frame that?
They classify Terafab as a structural source of incremental WFE demand starting in 2027. It's an ongoing, massive driver of spending that standard historical models simply hadn't accounted for.
Okay, so the total pie is undeniably growing. But the report makes a very clear case that all semi-cap stocks are not created equal in this new reality.
Not at all.
They establish a stark bull and bear risk-reward framework for the major players, and the divergence in their projections is massive.
It really is. The clear winners identified in the analysis are Applied Materials, often called AMAT in the industry, and Tokyo Electron.
Okay.
They offer what financial analysts call the most asymmetric upside.
Meaning the potential reward heavily outweighs the potential risk for an investor.
Precisely. And the math on that asymmetry is wild. Even in their absolute worst-case bear scenario where hyperscalers severely pull back their AI spending to just, say, 5 or 10% growth by 2028.
Which would be a huge slowdown.
Huge.
Yeah.
But even then, AMAT still has roughly 29% upside from its current valuation.
Wow. Even if everything goes wrong.
Yeah. And in a bull case where hyperscaler spending accelerates, AMAT boasts around 51% upside.
That's incredible.
Lam Research also screens incredibly well, offering a really balanced risk-reward profile, even if the broader market softens.
Okay, so on the flip side of all this optimism is KLA Corp, or KLAC.
Yes, the outlier.
The report views KLA's risk-reward as the least favorable of the bunch, explicitly stating it is already priced for a blue sky scenario.
Meaning the current stock price assumes everything is going to go perfectly for them.
Right. In their bull case, KLA only has about 10% upside. And in the bear case, it actually faces downside.
Which is quite a contrast.
Yeah, why the massive gap? I mean, they're all making chip manufacturing equipment, right?
They are, but they are making fundamentally different tools. And this gap comes down to a concept called WFE beta.
WFE beta.
Yeah, beta basically measures how sensitive a specific company's revenue is to the overall ups and downs of the broader market.
Okay.
KLA specializes in process control. These are the incredibly advanced optical and laser machines that inspect the silicon wafers for microscopic defects during manufacturing.
So it's pure quality assurance.
Exactly.
And you need quality assurance whether you are building a cutting-edge AI processor or just a legacy chip for a smart refrigerator.
Which naturally dampens their volatility. KLA's business model doesn't crash as hard during down cycles, but it also doesn't spike as aggressively during massive up cycles.
Okay, I see.
Applied Materials and Lam Research, however, specialize in deposition and etch.
Okay, let's break those down because the physics here are critical to understanding the stock prices.
Sure. So deposition is the process of laying down microscopically thin layers of exotic materials onto the silicon wafer.
Like a microscopic 3D printer.
Kind of, yeah. And then etch is the process of carving incredibly precise, deep canyons and patterns into those layers.
Okay, here's where it gets really interesting based on the report. AI chips require a fundamentally different architecture than older chips.
They do.
To get more processing power, manufacturers can't just make the chips wider because they're running out of two-dimensional space, so they have to build them taller.
Right, they're stacking memory components vertically and moving to complex 3D logic gate structures.
And stacking vertically literally requires carving deeper microscopic canyons with those advanced etch tools and filling those deeper canyons with complex new materials through deposition.
You've got it. The physical intensity of those two specific processes goes up exponentially for AI chips compared to standard chips. That is exactly why AMAT and Lam have extremely high WFE betas. Their revenue tracks the AI upcycle aggressively because the physical architecture of the chips demands exponentially more of their specific machines.
Okay, so going back to the construction world, KLA is the building inspector.
Right.
You pay the inspector a steady fee whether you're building a modest townhouse or a massive skyscraper.
Yeah.
But AMAT and Lam are providing the heavy steel and the cranes.
Perfect analogy.
So when the industry suddenly decides to build a complex new 3D skyscraper like high bandwidth memory, you need a massive surge in brand new cranes and steel.
That perfectly explains the blue sky problem with KLA's stock right now. The market already views KLA as the safe, steady harbor, so its valuation has run up incredibly high as investors sought safety. The irony is that right now, because of that high premium price, KLA is actually the most vulnerable to a pullback if the broader market stumbles.
It's like KLA is the straight-A student who already has a 99% in the class.
Yeah, exactly.
The market expects absolute perfection, so there's almost no room to improve their grade, but plenty of room to fall if they slip up even a fraction of an inch.
Right. If you believe we're entering a sustained multi-year supercycle driven by trillion-dollar budgets and projects like TerraFab, the data strongly suggests you want exposure to the high beta companies supplying the heavy steel.
That makes total sense.
But we also have to look beyond the U.S. ecosystem.
Oh, right. Because that very same global consolidation dominated heavily by U.S., Dutch, and Japanese firms creates a massive vulnerability for countries locked out of that network.
Which introduces the parallel universe the report outlines, the Chinese domestic market.
And the growth projections in that parallel universe are striking. The report forecasts that Chinese domestic equipment companies will capture a massive 40% of the China WFE market by 2028.
That's huge.
Especially considering that in 2020, Chinese domestic suppliers accounted for just 10% of their local market. We're talking about a four-fold increase in market share in under a decade.
It's a structural transformation of an entire national supply chain, and it's driven aggressively by an existential need for security.
Right. China is actively working to reduce its reliance on foreign technology due to immense geopolitical tensions and export controls.
They are also pursuing cost-saving considerations as their domestic alternatives begin to mature. The report highlights two specific Chinese suppliers benefiting immensely from this forced isolation, AMES and NAC RO.
Yeah, and these companies aren't just coasting on government mandates, right? They are aggressively scaling up their own technological capabilities.
Oh, absolutely. AME, for instance, just launched new high-selectivity etchers and is acquiring a majority stake in a CMP supplier.
For you listening, CMP, or chemical mechanical planarization, is basically the microscopic sanding and polishing process that flattens out the silicon wafer perfectly between adding new layers.
It's incredibly precise work.
Yeah, and AMI wants to own that vital piece of the puzzle too.
NAI is doing the exact same thing, accelerating its product roadmap to cover thermal processes, advanced cleaning, and ion implantation.
So they're building out the whole suite.
Yeah. And the math reflects the sheer momentum of this domestic substitution trend. These domestic market share gains act as a powerful, localized buffer against any global macro downturns for these specific companies.
So the risk-reward profiles on paper are explosive.
Very.
Even in a worst-case bear scenario where the overall global market softens, AMEC still has an 11% upside, and AEI has a 5% upside.
Right.
And in the bull case, we were looking at up to 53% upside for AME and 46% for ANEI.
Which brings us to the core risk listed in the report for these entities, expanding U.S. export restrictions.
Right. I want to throw an analogy at you to capture this specific risk.
Go for it.
It feels like investing in these Chinese firms is like betting on a racehorse that is objectively getting faster and faster every single day.
Yeah.
But the race isn't happening on a normal track. It's happening while track officials actively throw barricades onto the dirt.
That's pretty accurate.
Like, they could suddenly ban the export of a specialized subcomponent that AMEC needs to build its own advanced etchers. The horse is remarkably fast, but the obstacles are entirely unpredictable.
The valuations in the report are incredibly attractive based strictly on the current regulatory environment.
Right.
But if those restrictions were to suddenly expand, say targeting mature, older node fabs rather than just the cutting-edge advanced nodes, it would severely disrupt the demand for equipment from both AMS and AMEAO almost overnight.
So the geopolitical risk isn't just a hurdle. It could rewrite the rules of the entire race while they are running it.
Exactly.
So what does this all mean? You've got this massive global AI supercycle driving unprecedented physical spending.
Right.
You have localized booms driven by supply chain paranoia. And you have these complex risk-reward frameworks separating the winners from the losers. We've reached the end of today's deep dive, and the major takeaway here, the shortcut to being truly well-informed on this topic, is knowing that you have to look under the hood.
It's not enough to just buy a broad semiconductor ETF and assume you're perfectly positioned for the AI boom.
No, you have to know which companies manufacture the specific tools, like deposition and etch, that are hypersensitive to the AI boom due to the physics of vertical 3D chip structures.
You need to know the difference between supplying the structural steel and inspecting the building.
Exactly. And most importantly, you have to pay close attention to which futuristic blue sky scenarios are already baked into a stock's current price, and which ones actually still have room to run.
And, this raises an important question and a subtle risk mentioned deep in the report.
Okay, what's that?
The lag in AI monetization.
Ooh.
We've spent this entire time talking about hyperscalers spending over $1 trillion by 2028 to build massive physical server farms. But what if they struggle to actually monetize the AI services those chips provide?
Oh, wow.
What happens if consumers and businesses simply don't buy enough AI subscriptions to justify a $1 trillion infrastructure bill?
That is the ultimate reality check for the entire industry. If the software monetization fails, what happens to the secondary market for all this incredibly expensive wafer fab equipment? Could we see a future where these massive, shiny terawatt-scale fabs are suddenly forced to pivot from building high-end AI chips to building something completely different just to keep the lights on and pay off the machinery?
It's a cascading effect that could reshape the hardware landscape overnight. If the software doesn't pay out, the hardware orders stop, and those 50% upside projections vanish.
Yeah.
It is something for you to keep a very close eye on as this AI arms race continues to accelerate.
It all comes back to that heavy physical reality.
Yeah.
You can hype up the weightless algorithms all day long, but at the end of the day, someone has to pay for the concrete, the steel, and the hundreds of millions of dollars of machinery sitting on the factory floor.
Very true.
Thanks for joining us on this deep dive. Keep questioning the numbers behind the headlines, and we'll catch you next time.